Let me tell you a little bit about myself. I'm a former F-15 pilot, now a Georgia Tech professor, and at Georgia Tech I teach artificial intelligence and finance. One of the courses I've taught, a massive online open course, has had over 170,000 students in it. We've since transitioned that course to Udacity, and it's part of Georgia Tech's online master's degree program. My research has been reported in a number of venues like CNN and New York Times. Anyhow, to give you a little bit of an overview of this talk, I expect we'll go for about 30-35 minutes. And my objective here is to show you at a high level the technologies we use at Lucena to administer two very interesting and well-performing funds. I'll tell you about the machine learning that we use to make those happen. We have also more detailed presentations, webinars that are available at our website. If you want to know, for instance, about the genetic algorithms that we use, we've got a webinar about that you can see. And of course, I'll leave room for questions and answers at the end in case you have any. I'd like to recognize also my co-founder, Erez Katz. He's a serial entrepreneur, and his specialty was creation of, he supported cloud-based applications for his clients. And because of that specialty, we ended up having a great match. My specialty, of course, was in creating the algorithms that run behind the scenes to drive strategies. And he helped create the front end, which is a very visually appealing way to access our technologies. Anyways, we're now a company of 10 people in Atlanta, Georgia, and we're glad to offer our services, and I'll tell you about those in just a second. Before I get into the details about these strategies and what our services are, I want to give you a little background about where I come from. So this is a video of a robot that I helped create about 7 years ago. This was a contract with the Department of Defense, and the Department of Defense wanted to create robots that they could send to the field that soldiers could train. In other words, they didn't want the soldiers to have to write software to drive the robots around. They wanted the robots to be able to learn from the soldiers. Now, when I play this video, there's going to be my voice on there because it's a recording of me working with a graduate student. So I'll put it on pause every now and then to tell you what's going on. Okay, so the robot's been trained a little bit, and we just released it to let it drive down this path. And the objective for training here is that it should be able to navigate on its own. Now, as you can see right here, it's making a mistake. It's driven off the path. So what we do is we bring it back, and we switch on the learning switch, and we drive it back over that same environment. And what's happening now when it's driving with the learning switch turned on is a human is driving it, and the robot is observing what it sees and what the human says to do. And this is called supervised learning. So here we go. My grad student is driving the robot back over that problem area, and the robot's observing what it sees and what the human says to do, and it's recording that. Now we're able to start it again, and as it drives along here, it's looking, I see this, what did the human say to do? It recalls that, and then it does a great job navigating this kind of challenging terrain. So the reason I showed you this video is because I think it's an easy way to understand supervised learning. Namely, you show the agent or robot examples, and it sees what to do, and it recalls that at runtime. And in the same way, we can train systems essentially how to trade on the stock market. And we've used a lot of these same algorithms in our work here at Lucena Research. So let me tell you now about our company, Lucena Research. We're a Georgia Tech spinoff. We're a startup in the Atlanta area. We do not manage money. We are a software company, and we enable investment professionals, specifically hedge funds and wealth advisors, on how to administer their strategies. And we also offer strategies to these wealth advisors so that they can offer them to their clients. And I'm going to give you details about two of our strategies that were built using our infrastructure. One thing I want to point out is the key to our success, and one of the things that differentiates us, is we look at lots and lots of data. So we have fundamental data, we have technical data, we have a number of proprietary data feeds. We scrape public data such as the Federal Reserve. And what our algorithms are able to do is to observe all these different data sources, see which ones work best together in combination, and provide the most predictive capability. And by fusing all these data sources, we're able to provide a number of strongly performing strategies. Now, this isn't easy. Each day, we ingest millions of data points. We're looking worldwide at assets internationally and in the US, over 15,000 assets worldwide. And our code is hundreds of thousands of lines long. We incorporate dozens of algorithms. The way we're able to make all this work is we've got a team of really strong quant developers, almost all of them out of Georgia Tech. Many of them actually have taken my class, but we've got really strong folks here building our code and producing our strategies, and that's what makes it all work. So let me talk a little bit about our procedure for creating a strategy. We're very careful and deliberate in the way that we do it. First, there's a spark of an idea somewhere. Often a quant will have their own idea of something that might work. We'll see something in the news and so on, but we'll begin to build code around that idea. And that's a key thing, is we always start by building software that implements a strategy, because once we have that software, we're able to backtest it. In other words, we can roll back time and simulate how it would have worked and see how effective it is. And in fact, that's the second step of our approach, backtesting. So an important aspect of our backtesting or our simulations is that we roll back time and we don't allow the system to see into the future. In other words, that program can only see what it would have seen at that point in time historically. So we let it observe what it might have known. It can make investment decisions, enter those positions. Usually we trade on a monthly time frame. So we go forward a month, again, expose it to the information it would have had, and continue on forward and forward. Once we find a strategy or strategies that look good in this back testing, we then begin paper trading, what we call forward testing. In other words, to ensure that there's no sort of cheating going on where the system might be peeking into the future, we say, hey, program, as of today, real live today, what would you do? And we take those orders, we record them in our system, and of course it can't peek into the future because we're running it, right now, today. We continue that forward to observe how it would have worked if we were trading real money, and if it passes those tests, then we move on to live trading. So here are two of our strategies that we presently offer. We have some others as well, but I wanted to focus on these two because they represent two types of approaches that are significantly different and might appeal to different sorts of clients. So let me mention first Black Dog. So Black Dog is a risk parity approach that invests in stocks and bonds. Actually, we're going to expand that now to include preferred stocks. It's long only, which means it can only make positive bets on various assets. We allocate to each of these assets systematically according to risk. And what that means is that we look at the recent volatility of each of these asset classes. We look at the volatility of our equity positions, we look at the volatility of our bond positions and our preferreds, and we allocate according to risk such that we have essentially the same amount of funds exposed to the same amount of risk in each of those asset classes. This is an approach initially pioneered by Ray Dalio at Bridgewater. The hedge fund AQR also offers a strategy like this. I want to say that ours is strongly outperforming both of those, so we're really excited about that. And I'll show you some historical performance charts in just a moment. The other strategy that I'm going to talk about, and I'm going to go into more detail on this one, is Tiebreaker. So this one leverages machine learning. It invests only in stocks. It's a long-short approach, and this one trades at much more high frequency than Black Dog. Black Dog is a monthly strategy. Tiebreaker runs weekly. And again, Tiebreaker is outperforming S&P 500 as well. Now, two things I want you to come away with after this presentation. One is I want, a lot of folks are uneasy about machine-based trading algorithms, and I hope that at the end of this you'll see that there's value there and it doesn't make you uneasy. Two, lots of folks are uneasy about shorting. They think it's a risky approach, and I hope that at the end of this talk you'll also be more comfortable with algorithms that include shorting as part of what they do. Okay, this is the performance of Black Dog since it's been traded live. And I show here, so orange here is the performance of the strategy. Blue is the performance of a similar strategy by AQR, their risk parity fund. I want to also show you on our platform, let me exit PowerPoint real quick, a longer term back test of Black Dog. So this is on our platform, QuantDesk. And again, orange represents the performance of the strategy we're looking at, Black Dog. In this case, blue is the S&P 500. This is a back test since beginning of 2008. And you can see it's very, very strongly outperformed the S&P 500 over that time. However, while it still has outperformed S&P 500 over the last year or so, we are not happy with this downward trajectory. It's, again, it's outperforming S&P 500. It's outperforming other risk parity approaches, but we want to see what we can do to, make positive performance over this time. So we've investigated a couple approaches for how to do that, and one of them, let me turn my slides back on. One of them is using this new asset class, preferred stocks. I'm going to show you here real quick a back test using that additional asset class. So as you can see, this again, this is back test. It's got really stellar performance, again, all the way since 2008, but most importantly, positive performance over this last year. So we think including preferreds in this strategy is going to be a big bonus, and we're making that transition within Black Dog. So I just wanted to point that out, that we are continually improving our strategies, and this is an example of one way that we're doing that. Now, I also want to point out that backtests often are more glowing than what you actually discover in real trading. So we're expecting that we're not going to see this fantastic performance continuing, but we think at least we'll see a better performance than what we've had recently. Now, something to note here, year by year, this strategy has made money every year since 2008, and it's outperformed the market almost every year as well. So like I said, I'm really looking forward to updating this strategy. Okay, now, Black Dog looks pretty good, but there are some failings. There are some weak spots. And I want you now to consider, what might we do to improve it? So in particular, we sometimes have these drawdowns. It's hard to see, but because it's long only, we often have drawdowns in concert with the market. What can we do about that? So let's take a look at these shortcomings. Black Dog, like I said, is long only, and it's rebalanced monthly. Actually, rebalancing monthly is typically a good thing because it means your market impact is reduced. But it also means that your strategy isn't responding as quickly as it might to market conditions. What if we consider a long-short strategy and more frequent trading? And that's in fact what we're doing with Tiebreaker. So I want to spend a little bit of time now talking about, why shorting is not necessarily risky. So shorting is an important component of our Tiebreaker strategy. And like I said, lots of folks consider shorting to be risky or a little bit scary. And I'm hoping to show you here why you should be a little bit more comfortable about strategies that short. Now, I should say there are risky ways to short. The approach I'm going to show you here, I think, is actually an approach that strongly reduces risk in a portfolio. But there are other ways of shorting and other short strategies that are certainly risky. But this is a way to use shorting that reduces risk. Now let's roll back time and consider this example. Assume we're back in June 2015, and for whatever reason, we believe Delta Airlines, DAL, is going to outperform other airlines. One reason we might have thought that is because we were beginning to see oil prices come down significantly. And as you probably know, energy is the #1 cost on the balance sheet for most airlines. So if we're seeing low energy costs going into the future, that might help us. That might imply that airlines are a good investment. Now, one thing to know about airlines is some of them hedge their energy costs. So just because oil is going down in price doesn't mean that they're necessarily going to benefit from that. So Southwest Airlines, I believe, was hedging their energy costs. Delta was not. So Delta was in a position more easily to benefit from that downturn in oil prices. Now, notice I didn't say that we know Delta is going to go up. I said we think Delta will outperform other airlines. We don't know whether Delta is going to go up or down overall. We just think that whichever way it goes, it's probably going to do better than other airlines. So what can we do about that? Well, one idea is let's buy Delta stock and short American. Let's see how that would have worked. So on the top part here is a chart showing the performance of Delta here in blue since June 2015, and American here in red. Now, a couple things to note here. Oh, and by the way, S&P 500 is in yellow. A couple things to note here is the prices of these two stocks are very strongly correlated. Here there was a downturn in Delta, downturn in American, downturn in the stock market overall. But over time, we see that the difference between Delta and American grows. And after the 6 months here, we see Delta's gone up 20% and American has been more or less flat. Now, one thing I want to point out here is that the strongest influence in price changes from day to day is what is the overall market doing. So the market went down here, both American and Delta went down. What shorting enables you to do is to essentially erase that impact of the market on your investment. So if we go long Delta and we're short American, this downturn you see here essentially doesn't happen because as the market and our airline prices go down, we're positive Delta, negative American, and they cancel each other out. And in fact, at the end here, over this time, what we capture is the difference between these two. So we don't get fully 20%, but we end up gaining about 7% over this time. But we have a much smoother performance. So down here is a backtest showing that. So green here represents performance of Delta over this time. Orange represents the performance of our overall portfolio, which is half long Delta and half short American. And notice how smooth it is. Notice that we avoid totally this big drawdown back towards the end of August 2015. So we reduce the volatility and we are able to capture this difference between what Delta and American did. So key point here is we substantially reduce the volatility in our portfolio by longing a stock we felt would go up, shorting another stock that we didn't know which way it was going to go, but it just represented essentially the airline industry overall. And we're able to essentially erase our exposure to market risk and to sector risk of that airline. Now, you might say, okay, well, both of these stocks went up, and it's not surprising you were able to make money with both of them going up. Well, let's look at another example. Here's an example of two assets that went down. Again, going back to June 2015, looking at two assets here, Exxon and Cabot Oil. As you can see, Cabot lost substantially, whereas Exxon didn't. Now you might wonder why. Well, it's because Exxon isn't purely about oil, whereas Cabot is more directly about oil. So Exxon is selling gas to retail clients. So although they're certainly exposed to energy risk, they're not as directly exposed as companies that are directly pulling oil out of the ground. So same idea here. We go long Exxon, so we buy positive shares in Exxon, and we short Cabot Oil. And even though both of these assets went down, Exxon about 7%, Cabot about 45%, our overall portfolio gains money because we make more money from Cabot Oil going down than we lose, because we're short, than we lose with Exxon going down. And again, here orange represents our portfolio value over time. Notice that it's much less volatile than our core of Exxon, and we gain again the difference between these two over time. So positive 35% or so. Okay, I'm going to pause for a moment and take a look at any questions we might have here and address them. So someone says this is the same as the ML for trading course. that I teach? Well, yes. I preach what I teach, or I put my money where my mouth is. I believe this stuff, and it works. Another question, is the black dog strategy performance theoretical or real one? So the chart I showed you for black dog, I showed you two charts. One was a back test since 2008, and that was essentially sort of theoretical up until 2014. But the other chart I showed you is live trading since 2014. So we have actual accounts traded using black dog, and those charts are real. Another question, why don't you include all relevant asset classes rather than picking and choosing? I think that question is in reference to which asset classes do we include in Black Dog, and we started with equities and fixed income. One reason is because the industry overall has recognized that those asset classes are essential to a balanced portfolio. You know, we weren't the first ones to stumble upon them, and we wanted to see how can we best improve performance with those two asset classes, and that was the origin of Black Dog. We have since experienced, you know, market turbulence, as you're aware, and one of the things we want to do is see how we can improve that, and so we begin to carefully look at additional asset classes. We've added REITs, for instance, and like I said, preferred stocks. The reason we add them is each one that we consider, we throw it into a backtest. And in order for us to consider it going forward, it's got to show that it helps performance historically in our backtests. And of all the asset classes that we've considered adding, preferred stocks are showing the best improvement. Okay, a couple more questions. Do you build trading cost assumptions into your backtest performance? Yes, all these backtests that I've showed you include commissions and also market impact models. So we assume that every time we trade, the market moves against us. In other words, we have a historical record of what the prices were, but we assume, for instance, that if we're buying, the cost would be a little bit higher, or if we're selling, the price would be a little bit lower. So we're assuming that we impact the market when we do that. If so, how are you simulating the cost? Well, for commissions, we just use directly, actually, the interactive broker commission rates. In terms of market impact, we typically assume 5 basis points move against us. Okay, I'm going to continue on now. I've spent a little bit of time talking about shorting and, you know, how that can reduce volatility in a portfolio and how you can gain performance. I want to talk now about hedging. So Tiebreaker uses shorting. It's a long short strategy. It also uses a proprietary Lucena technique where we find hedges to hedge the overall position. Let me tell you a little bit about that before I launch into, you know, telling you about our hedger. The first thing we do with Tiebreaker, by the way, it's a weekly strategy, so we repeat this each week. First thing we do is we find our long positions, and we use a machine learning technique across hundreds of potential factors. We narrow things down to about 10 factors that we consider, and each week we make a 1-week forecast for all stocks in the Russell 1000. We end up narrowing things down to 5 stocks that we see the most promise in, and that becomes our core portfolio. Now we want to find a hedge against that core. to reduce risk, as I've shown you with those short slides. So I'm going to tell you now how we find that hedge. Before I tell you all the details about the hedger, I need to tell you a little bit about this underlying technology we have called portfolio replication. I'm going to tell you about that, and then I'll show you how we use that to hedge. So our problem or our task for portfolio replication is, given some historical price history, find a basket of stocks that will reproduce that price history. So as an example, we gave this problem to our hedger. We said, here is the historical performance of the Dow Jones. Tell us what stocks are in that portfolio. Now, you might say, okay, well, we know which 30 stocks are in the Dow Jones portfolio. Well, yes, we know, but the program didn't know. So we gave it this task of looking at the historical performance of the Dow, find out what's in it. And the reason that's an interesting experiment is we can check to see if it's right. And here you can see the red is the actual performance of the Dow before this time. This vertical line represents the time where we ran our hedger. It only has access to information before this time. And the green represents the portfolio that it found. And as you can see, it tracks it pretty nicely. And going forward after this time, it tracks it so closely that you can't see the synthetic portfolio over the actual Dow portfolio underneath there. So it found exactly, it found 28 of the members of the Dow exactly. It missed 2. One, for instance, that it missed was it picked Chevron instead of Exxon. But the others it nailed exactly. And it also figured out the proportions of each of those stocks in the Dow. Okay, so now we have this method of matching a price history by finding, discovering what's in that portfolio. How can we use that for a hedger? So here's how we take that portfolio replication technology and use it to hedge. Let's suppose this blue line represents the historical performance of our portfolio. This is the thing that we want to hedge. Now, what do we want the performance of our overall portfolio to look like? In other words, if it were hedged, what would we hope our trend line would look like? Well, it'd be great if we got the same positive performance as our portfolio, but essentially with the risk taken out. So this red line represents essentially a extremely low risk performance, but providing the same gains as our original portfolio. So how can we accomplish that? Well, if we had some other component in our portfolio that matched this green line, so imagine we have half of our portfolio in the core or the blue, and the other half in what's represented by that green line, then together our overall portfolio would have exactly this smooth diagonal line performance. So what we do is we ask our portfolio replication program, hey, find me the stocks that are in that green line. And that's how we find the hedge. Now we can ask the hedger to do this by finding shorts only, or we can actually ask it to find longs as well. And finally, another option is it can find long and short combined hedges. But the key idea here is that it strives to find equities that all together will provide the performance of this green line, and when we add them to our portfolio, we get this smooth performance here. Now this is all look back, so we don't necessarily know that this performance is going to continue into the future, but typically we see that our hedges perform very well because we're not predicting which way their prices are going to go. we're predicting how they are going to respond to other stocks. And that sort of relationship tends to persist into the future. In other words, we don't necessarily have to know which way the price is going to go, but we do need to know how it's going to respond to the other stocks in our portfolio. So let me see if we've got some other questions here. Okay, so this was for an earlier, this question is in response to an earlier slide, but I think it's an important question. Thank you for the answer, but isn't that data mining? And it's in reference to selecting which assets would improve Black Dog, I think is what's being asked here. Yes, we are subject to the data mining fallacy, and let me restate that for folks. Is if you search over an infinite number of random strategies, you will find some that perform excellently. And the question is that historical performance just luck that you happened to stumble upon and it won't really persist into the future, or does it represent actual insight that is worth investing in? And the answer is when you first discover it, you don't know. It could be subject to the data mining fallacy, and maybe the performance is not going to continue into the future. And however, turning that back around, if it doesn't perform well in a backtest, there's no way it's going to perform well in real life. So backtesting provides a way of sort of screening for at least a set of strategies that might work. Next step is forward testing. So now that we have a candidate strategy, in our case, something that now is going to include preferreds, how do we validate that? Well, we start tracking it. We say, okay, going forward now, how would our portfolio have worked if we were using this additional asset class? And if we see validation in that over some period of time, that gives us the expectation that it's not just data mining. Yeah, we're still somewhat subject to that, but that's the way that we reduce our exposure. Also, it has to make sense, and one reason preferreds make sense in this strategy is that they're really somewhere between equities and bonds, and our overall portfolio contains those two assets, and this just provides another class that's a bridge between the two. Another similar question. You mentioned earlier that backtesting often sugarcoats real-world performance. What would cause this? Well, actually, I think I addressed that in my previous answer. Essentially, so this is a great quote by somebody from Barra, and it goes something like this. I've never seen a bad backtest. So we and others in this industry spend a lot of time testing strategies, and we go through hundreds and hundreds that don't perform well, and we only end up carrying forward the ones that we see performed well in backtesting. But again, there's always some amount of luck in that backtest working well, and we just see over and over again that if in backtesting you see a Sharpe ratio, very high Sharpe ratio or very high performance, that in real life you're only going to get 50 to 70% of that going forward. And why? Well, part of it has to do with that degree of luck. Another part probably has to do with market impact. What is the look-back period for the hedger? Another question. It's selectable. We typically use 3 months, but we can select anywhere from 1 week to 1 year to construct that hedge. Last question before I move on. Does your hedge finder explicitly preserve positive exposure to the characteristics which led you to create the core portfolio? No. Our hedge finder is looking exclusively at historical price performance, and it's looking for correlations or anti-correlations among those historical values. Now, it turns out that there's a reason that different stocks are correlated or uncorrelated, and that's because structurally they have some sort of relationship that we're able to exploit. So if you look at equities that the hedge finder recommends, and then look more deeply at your core portfolio, you'll often find interesting relationships there. Okay, we'll move forward now. So here is the performance of Tiebreaker. This is live traded about 18 months. The orange line there is the performance of the strategy. The blue line is performance of the S&P 500. So a couple things to note. The recent big downturn in August 2015 we avoided. In fact, we've made money in 2014 and 2015. We are actually now positive for 2016. This chart was run last week. So we've, over these 3 years, we've outperformed the S&P 500 each year, and we're actually up a few percent this year. A reason for this is, well, at least in comparison to Black Dog, is that we're able to be long short. Let me step real quickly through the procedure, how Tiebreaker works. Our universe is Russell 1000 and S&P 500. Our first step is we run all these stocks through a scan. In other words, we have certain thresholds for different factors that a stock must meet before we step forward on that. These are fundamental and technical factors. Of the stocks that pass those screens, we make a forecast for all of them using a machine learning technique. And we choose the 5 stocks that we think are going to perform best over the next week. So that forms our core portfolio. We then optimize that portfolio using a mean variance optimizer. And finally, we add the hedge. And we perform this weekly. So we exit all of our positions Monday at close, and we enter a new set of positions Tuesday morning. So that's what I wanted to cover. I showed you 2 strategies: Black Dog, which is a risk parity approach that's outperforming the market, and benchmarks, which are namely other risk parity approaches, and Tiebreaker, that is a long short approach using machine learning techniques. And if you're interested in either of these strategies, please reach out. You can send me email, tucker@lucenaresearch.com, or our CEO, eras@lucenaresearch.com. And I'll take a few minutes to answer any remaining questions that we might have. So I'll start with those questions. You talked about supervised learning. How do you formulate the procedure you described, that is, given historical prices, what is being learned? So the way we frame supervised learning for our machine learning techniques is first we identify features that we're going to use. So in other words, which technical factors, which fundamental factors or even which macroeconomic factors do we think are predictive. And it's a whole separate process determining those factors, which I'll be glad to talk about. But once we have those factors, we can now roll back time, and for each stock that we look at, we can historically determine what were the value of those factors on any particular date. And then we can look forward and say, okay, how did the stock's price change going forward? So in the supervised learning context, we're saying you observed these factors, and then the outcome was this result a week later. And that's what we trained the system with. Next question. I always see the backtest after the 2008 collapse. Would be interesting to see how the system behaved in critical situations. Well, so just to be clear, this is not a backtest. This is actual live trading. We do have a backtest for Tiebreaker that goes back to 2008, and it performs similarly. You know, I think most long-short strategies, if they were truly long-short, probably did fairly well through 2008, 2009, at least in the sense that they didn't have significant drawdown. Anyways, I also showed you a backtest for Black Dog that started since 2008. So we always look at what happened to these strategies during those critical times. And in fact, Erez, in his recent weekly email, analyzed how Tiebreaker performed historically during some of these critical times. So if you're interested in that information, reach out to us and we can resend you that newsletter. Another question, if a user's strategy generates good backtest and paper result, will Lucena consider allocating money to this strategy? Like I said, we don't run money ourselves. If you do develop a good strategy, we certainly are interested to talk with you about it and see how we might monetize it. But whatever it is, it has to be operating within our ecosystem, within our structure. Next question. May the performance between backtest and forward test be attributed to chaos in the data? Certainly, and again, we to some extent, although we're not intending to, we're cherry picking good results, and good results are always somewhat subject to randomness, and that randomness might not continue in our favor going into the future. So we're always hoping that there's some underlying property that's causing the performance to be good, and at least we capture that, but we might lose the randomness that had been in our favor. Another question, how does this compare to the AQR fund QMNIX? Let me follow up with you separately on that. I want to be sure we have the data for that fund in our system, but be glad to run a comparison and share that with you. Next question? Do you hold your positions throughout the week, irrespective of performance? No, we set stop loss and stop gain limits on all of the positions, and we usually have exited about half of the positions by the time we get to the next Monday. So we're typically in 5 long positions, 10 short positions, and we get stopped out of them either by gain or by loss. By the time we get to the following Monday, we're usually remaining in about 7 positions that we finally exit on Monday. Next question. Can retail investors use these tools? So there's two ways to access our tools. One is by subscribing directly. I will say that the pricing is not the $20 per month kind of pricing that you might be used to. We're actually fairly expensive, but we offer our strategies to registered investment advisors. And in other words, if you were interested in investing in some of these strategies, you could allow one of our partners to manage funds for you. And I'd be glad to follow up with you on that. Next question. Would you be making this recorded webinar available? Yes. And we'll send email out to you later on with a link to this video. Next question. Do you use models? I'm sorry, do you use options? No, we do not use options. Everything is ETFs, stocks, mutual funds. We also cover international equities, but we don't use options. Next question. How does one invest in Black Dog or Tiebreaker? Great question. The way it works is we connect you with one of our partners. We have several registered investment advisors that we work with. And the way it works is you open an account with Interactive Brokers, make a deposit there, and then you allow our partner to trade within that account. It's totally visible to you all the time. There's nothing hidden. You can go in there at any point in time you like and see what the investments are. You can withdraw as you like and so on. And our managers only have permission to trade according to our strategies. They can't take money out or anything like that. Next question, how long is the look-back period for the underlying Tiebreaker strategy? I have to say I'm not certain about that. That's a question for my colleague, Eris Katz. I suspect it's on the order of 3 months because we typically use that look-back period for most of what we do. Enjoyed the presentation? You're welcome. Next question. What machine learning algorithms do you utilize? We use we've got a genetic algorithm, and we use k-nearest neighbor. We are now beginning to explore deep learning as implemented in artificial neural networks and reinforcement learning. Those are the next two learning methods on our plate that we're going to be moving to. Next question. Would non-US market folks be able to subscribe and leverage these strategies? Or would you be able to help me design it for my local market? Absolutely, yes. Like I said, we cover international equities. So, and some of our clients already are interested in strategies just like the ones we've got, but applied to particular regions. So follow up with us and we'll be glad to follow up with you. Last question. Okay, one more just popped up. What's the minimum investment needed if one uses one of your advisors? I am not certain of that number. I'm sure it's at least 100,000. Actually, because interest has been increasing, it's up to our particular partners what they will work with. But that number is going up because it's difficult for them to manage dozens of accounts simultaneously. So it's better if they have a few large accounts than tens of smaller accounts. But if you reach out to me, I'll be glad to connect you with our partner there who can set you up. Next question, are you ever going to have an ETF for Tiebreaker and or Black Dog? Good Good question. We are actively investigating that. What we've discovered is it doesn't start to make economic sense for us until we're up to at least 50 million assets under management. So right now we're building up the assets under management using separately managed accounts, and we're not, we're beginning to approach the 20 million mark. And when we start getting to 50 million, then we'll talk to those clients and approach them about the possibility of transitioning from separately managed account to investing in an ETF. But yeah, we are quite interested in offering those. Another question, what about commodities? We're interested in that as well. We currently don't have historical data for that. Next question, on this chart, performance date is 1/7/15. I don't know what you're referring to, but the chart we're looking at here goes from October, so this is October 2014 until present. How do you reach out? Here are our email addresses. Please send me an email, Tucker@LucenaResearch.com, and I'll be very happy to follow up with you.